think there's a saying that when your cab driver starts giving you stock advice, it's time to sell. My personal experience with that in GameStop right now is my hockey team's group chat is all GameStop today, so it's time to sell.
No.
A few moments later.
All right, welcome back, everybody. This is episode 22 of the Beyond the Edge podcast. We've got a full team here, Trend Tracker, Mr. Fundamentals, and myself, Small Cap Kev. As always, we've got a packed agenda. Lots of stuff happening lately. The emergence of Roaring Kitty, he's back. Sheen, IPO, full of scandal. We love a little bit of scandal in the podcast. That's possibly coming up as early as this, or even, I guess this week would mean tomorrow, most likely next week. Finally, new stock exchange, an anti-woke stock exchange in Texas. We are going to be looking forward to talking about that. So jumping straight in, GameStop. We've talked about this on the pod for the last few years. Even just last episode, we brought it up. The reason we talked about it on the pod last week was simply because Roaring Kitty hasn't been seen in a few years. He put a meme, posted a meme online showing someone playing video games leaning in. That was enough to send the GameStop into a frenzy. And it's just only gotten even more crazy since then. Also, we saw Nvidia become a $3 trillion market cap company. It is a bigger company than Apple now. Boys, what? Did you see this coming at all? Like, Trend Tracker, Pete, you following Nvidia? Like, what is the hell is going on?
Yeah, I think we're in uncharted territory. This is bigger than a stock exchange we're going to talk about later that Sheen is hoping to list on. Nvidia is now bigger than all the companies on the London Stock Exchange in terms of market cap.
Wow.
Yeah. So I think that we're just really trying to grasp how big a $3 trillion valuation is. And look, I was all for it. This was something that was on my watch list. This was something I would have talked about, almost a year ago with people, to start looking on the outskirts of AI, start looking at companies that will benefit, start thinking where this money from this AI explosion is going to flow. Don't just get kind of caught on these LLMs, because we're starting to see the democratization of those. Those are becoming cheaper. That's just going to become something we expect. But where is this money going, right? So I don't know if you think of it as a gold rush. Back in kind of the Klondike gold rush era, a lot of people had to buy shovels. So, I think we're kind of seeing that benefit, but $3 trillion, guys, it's a lot of money.
Just for context, I was curious. I looked at the GDP of Canada, and it's just over 2 trillion. So this is one single
a year. Okay, a year.
Fine. But I'm just giving you a scale of, okay, fine. I guess I went valuation compared to revenue. Fair enough. That's a bit of an apple to tomato, but I'm just giving you some kind of scale that is a lot. Big freaking company. I'd be curious what like Canada's annual tax revenue they bring, and maybe that would be a more fair comparison. But anyways,
our federal budget in terms of that is similar to the revenue of Google. So these are big companies in the States. Yeah.
Wow, that's crazy.
Mm-hmm.
So, that's NVIDIA. Declan, you like NVIDIA. You've had positive things to say. Obviously, it's a very fundamentally solid business. We really dug into it last week. But, did you see this thing becoming a bigger company than Apple? How about I'll ask you that?
Yeah, difficult to comprehend, Kev. When you look at their growth and the year-over-year comparisons, it's unheard of, the size and scale that they've expanded to. And so, again, just reiterating, as we've discussed in the past, I think you got to just ask yourself, is NVIDIA a more attractive investment at $3 trillion compared to when it was just a $200 billion company about 2 years ago? So I think that's where I look at it. Ultimately, if they keep running and keep doing well, the stock could keep on going higher. But you just have to ask yourself, is this an attractive price to buy it at? Or is it probably best to sit on the sidelines and maybe wait for a better opportunity further down the road?
Great question.
Yeah, I would say when you think of something, you say sky's the limit. This is probably the sky. I don't know. What can it do? Can it become a $4 trillion company in the near term? It's really tough to say, but there has to be something. Like when you're talking about this, it's almost at the same size as the Toronto Stock Exchange. Toronto Stock Exchange has, some of the most valuable banks in the world on there, some of the most valuable insurance companies in the world. Like, I get it. We are firm believers in AI. It's going to change everything. We're all in on that. We've been joking about what a .ai company can mean for your business, but we got to be reaching some type of the ceiling here.
I mean, yeah, you'd certainly think so. And it's funny what you mentioned about the .ai. I don't know if you guys read the article, but there's an island in, I think it's the Caribbean, that they're kind of, how do I explain this? They basically own .ai. Australia is .au, for example. Brazil has something, I think it's like .br. There's this tiny little island that's got .ai, and they rake in millions and millions of dollars just from all the companies bidding to get those. So get those URLs. So just a funny little side comment there.
Yeah, talk about selling shovels, hey?
That's
Jeez. Accidentally choosing the right shovel to sell.
Yep.
But okay, let's jump right in. I wanted to make a point that $3 trillion was unthinkable not too long ago. $1 trillion market cap was unthinkable. And now here we go. There's companies jumping into the club.
I don't know if I'm dating myself, but do you remember when the first $1 trillion company happened and where you were? I had a job at the time.
Was it not Apple?
It was in 2012.
Oh, was that like Nortel?
It was in 2012. It was Apple. Like, they were racing towards it all at the same time. I think I'm trying to remember which oil company and Apple were kind of like getting there, and then it happened, right? And everyone's like, "Oh my God, there's $1 trillion company." Most likely, yeah.
Okay.
But that was.
I thought this was going to be a trick question, and like
no.
There is some insane.
It's crazy just how long it took something to get to $1 trillion. That only happened 12 years ago, and now that to see 3 trillion in such a short time.
It was that long ago too. Hey, wow! I didn't know it was so.
Yeah, money used to be worth more. It was crazy before they started printing it nonstop. Yeah, it used to be worth a lot.
Yeah.
But yeah, sorry, Declan.
Someone fell asleep on the printing button.
Yeah.
Kidding, eh?
Okay, let's talk about GameStop. I'm guessing most people watching this video, that's probably why they're here. Guys, go back to the last video if you want to read or listen to more of our thoughts on this. We're not going to rehash everything we got into, but a few interesting points since then. You guys know that Keith Gill, his last post was, I believe it was 2021. He then disappeared. He then posted a meme, and now he's got a live stream scheduled for tomorrow. Which I'll 100% be watching. It has no context around what it's about or what's going on. That was enough to reignite this thing. His positions just in his options and ownership in the company, he made over $70 million in one day. So this thing is like back on. And his position is almost worth $300 million. Make it make sense. Mr. Fundamentals, what do you think about that?
Yeah, well, I think there's like two sides to the story on this one. So just some extra context on everything is now E-Trade, which I believe is Keith Gill's brokerage, is trying to ban him from the actual app because of everything that's going on. And so from that, the community has really responded and quite negatively towards E-Trade. I've seen a lot of posts on Twitter, or X as we call it now, and then also people like even contemplating like discontinuing their actual brokerage account just because of this. So there's one side of it where I think the general community of retail investors, they love Keith Gill. They are sticking it to the man with him, and they want him to continue to do what he's doing. On the other side, you kind of look at this and you have to wonder, well, is this stock manipulation? And so obviously, as we discussed about last week, Keith posts a meme and the market goes crazy. GameStop shoots up. Everybody's going, we're back, boys. This is time to roll it once again, right? He obviously tested the water there. Then this Sunday, he discloses his total position. And obviously it's a bullish signal. And everyone, once again, rallies behind that. And the stock shoots up. And like you said, Kev, he made about $70 million in a single day. Now, the question is here, if you look at the options that he has, they have an expiration date on June 21st. So not that far from here. He also clearly has a massive position in the company. And when he reveals that, and knowing the type of influence that he has, it begs the question, like, is he manipulating the market and should he get away with it? Now, if it's legal, then props to him. He's kind of found a way to beat the system. He's built his influence. Why not take that to your advantage? But at the same time, you're not seeing Warren Buffett going out there on tweets and saying, just bought a position in Apple XOXO and leaving it at that. So I think you just have to ask yourself too, is he going to be so transparent on the flip side when he starts to sell his position or liquidate some of those holdings that he has? And that's just where I ultimately don't have an answer what's right or wrong, but it's interesting to think about anyways.
Oh, I mean, yeah, quite a few things to cover. Is it manipulation? Sure. Yeah. But one, love watching it. I'm not part of this ride. I've said many times on this pod, nothing I would take part in myself. Is it manipulation any more than Elon tweeting about Tesla and those do things? Like, this is someone who fundamentally understands how stocks work as well. The fact, his position though, blew my mind. I can't think of, let's say, like how many people, Wall Street institutional or whatever type of professional traders could never see that type of money themselves and dedicate their whole lives to it. It's absolutely wild. I also don't know how much he cares to lose other than maybe wanting to take down funds in their short position. Like, is that his end game? I don't know if this guy's going to be that upset if he watches a $50 million paper gain go. Like, I don't know what his overall MO is. The future of the stock, those options expiring, that's a pretty good point. I think there's a saying that when your cab driver starts giving you stock advice, it's time to sell. My personal experience with that in GameStop right now is my hockey team's group chat is all GameStop today, so it's time to sell.
No.
Like, I would say I can't see it getting much higher than this. I will say though, on this pod, if you watch us 3 weeks ago when it peaked, we said, well, someone on this pod said, wait, it was me. Wait 3 weeks for the next one. We said the only thing I said, if history repeats itself, it'd be kind of 3 weeks, and we're 3 weeks to the day of the second rep. So that was what we said on the pod, and it happened. And my next prediction would be, I can't see it going too much higher, and it's probably time to sell if you have gains. Sorry. I know their whole, Wall Street Bets mantra is hold, and saying bad things to each other if you sell, but you got to get out. Yeah.
I mean, I think his stream tomorrow is going to be super telling because it could be one of those you buy the rumors, sell the news kind of things. And in this case, it's maybe the rumor was Keith has some amazing revelation and a whole well thought out thesis about why the trade isn't over, etc. And he may very well turn up the live stream tomorrow, show his account, repeat the same three things that he did years ago. Digital risks are overblown, negative sentiment is overdone, and the value is overlooked. And he may have nothing new to share. In fact, the business has fundamentally deteriorated since then, aside from having a whack of cash on the balance sheet from an equity issuance. And then it may disappoint the market, and then it may come down. If I was going to make a call, I wouldn't be surprised if after this stream tomorrow, so depending when that is, the first trading moment after that might be Monday, I would be not surprised if the stock fell after that. But only time will tell, so we'll see. And actually, while I'm kind of on this rant, and I mentioned those three things that he repeated over and over, I wanted to really relook at those again and kind of look back and be like, was he right? Was he wrong? And does that make sense right now? So the first is digital risks are overblown. He's basically saying there's a good reason for people to come into the stores, buy used and new video games. We think the likelihood of people streaming games and directly downloading to their console is overblown. I think that we can say 100% has just turned out to be completely inaccurate. The Digital Entertainment and Retail Association, it's a UK-based trade organization. They track physical and digital media sales for both music and video game industries. They estimate that 89.5% of games sold in 2022 were digital downloads. 2 years ago, only 10% was sold through a store. And GameStop has this massive amount of stores. I feel like it's when you're playing that punch buggy game, you see a VW and you get to punch somebody and all you can see is VWs. It's like that for me now. All I see is GameStops everywhere I'm driving, and all I think of is how expensive those leases probably are and how useless they're going to become. So thesis point number one turned out to be completely inaccurate. Moving on to number two, negative sentiment is overdone. I mean, I don't know, Trend Tracker, what do you think in terms of sentiment on this thing? Was it overblown or has it just got worse?
Yeah, no, I think the sentiment's kind of interesting, right? It's kind of a tale of a few different audiences. If we look at the core consumer, does the core consumer dislike GameStop? Like, no, like probably not. Are they losing them every day? Yes, but there's not a negative sentiment about the experience of going to a GameStop. Now, if we're talking about investor sentiment, that couldn't be further apart than how me and Mr. Fundamentals evaluate stocks. Like, I mean, there's some investors that are obviously are all in on this and riding it to the moon and really want to take down some of these hedge funds that are betting against them. Obviously, the people who are initially started shorting them had good reason, right? They had good reason that there was, a significant change in customer preference and how they might purchase these things. And, that's kind of like saying in the maybe 2010s, Amazon wasn't going to be a big deal. Like, yes, it is. Like how it's changed, how Amazon's changed my habit of what I think about leaving my house to purchase something is immense.
Yeah, fair. And I think that's a good point. The sentiment is like the barbell approach. It's both sides. It's very heavy. People love it. Yeah. People hate it. Mr. Fundamentals, what camp are you in now? Like, has anything changed over the last couple of weeks?
Yeah, well, I'll just go back to the Ben Graham adage of the market is a weighing machine over the long run and a voting machine over the short run. So we're going to have these times where people are obviously over optimistic about businesses that may not have the fundamentals support it. And like you said, Kev, even with the thesis point number 1, the trend is moving away from people buying physical discs and towards digital gaming. It's just much more cost effective for the producers. It poses less of an environmental risk. It also is a much easier distribution channel overall. So there's not much going other than perhaps game developers trying to just leverage every access point they can. And to be fair, again, GameStop has a strong brand, so you might as well keep using it until that runs out. But ultimately, over the long run, I just don't see any way that GameStop is going to exist. The question is that going to be 2 years from now, 5 years from now, 10 years from now? Who knows? And you're ultimately playing this investment right now because you're trying to take advantage of short-term gains. You're not investing in this because you think it's going to be the best business in 20 years from now. So that's kind of my stance is I would always just continue to watch from the sideline on this one.
Yeah,
exactly.
Yeah. But I love it. Whoever put money in this that is riding this and what the next 24 hours is going to be like for them. Like after hours trading is actually already up another $4. So it's going to be an interesting day for them tomorrow. I'm excited to be on the sidelines. And there could be some fireworks here for sure.
As ridiculous as I think the whole thing is, and I think you guys, nailed it when you're saying this isn't investing. It's whether you want to call it just pure speculation, manipulation is maybe more of an aggressive term, or just pure gambling. It's something other than investing. Doesn't mean you can't make money. We know that for sure. The number of times people have told me just to buy new highs and them turning out to be right more often than I'd like to admit. The trend often does continue. I mean, the trend is your friend until it isn't. What a useless quote, but you know what I mean? It's true though. Like you can ride trends, but if you're going to do that, if you want to play that game, you better be watching that chart to the second. Like that has to be your life. Otherwise, don't ever try to chase a trend like this because you need to be able to get out just as fast as you got in. And I bet you most of these investors, actually, to be fair, I bet you a lot of these retail investors are actually quite dialed into this. It seems to be like the livelihood for a lot of people. But if you're the one riding this wave and you're not that dialed in guy, good luck. Because at one point or another, I have no doubt that the rug is going to get pulled. And it's going to be bad news for anyone not paying attention. And that sucks. We don't like seeing retail investors lose money.
Oh, totally. Well, just like one final point here is just, I think there's just been such a dislocation between just in general, the market's assessment of risk. We've gotten away with a lot of things for the past decade and a bit here. And so our perception of what risk really is has really kind of gone away and up into the stratosphere where, again, people are willing to take these risks, and it extends to the gambling market and everything. Nowadays, there's just so many opportunities to try and make these quick profits, and there hasn't really been severe consequences for a long time. And I'm not saying there's going to be a market crash. It's impossible to predict where the market will go, but just that we've been given such a long grace period has, I believe, shaped investors' perception of risk overall. And so it'll be curious to see how long this whole story lasts and plays out. And I'm sure there will probably be other opportunities similar to it that people just, it doesn't make sense why a stock is shot up so much, but it does anyways.
We love it. We love it. Well, let's change gears. In fact, let's change countries too. Let's cross the sea, going over to London, possibly London's biggest ever stock market flotation. It's Shein, Chinese company. If you've heard of them, fast fashion, very similar to, I guess, Fashion Nova. They produce an unbelievable quantity of items, and they're all very cheap. And their real core strategy is influencers doing their Shein haul videos. This is a company that has no shortage of scandal and controversy. It's all news to me. I didn't know any of this was going on, but even years ago, they were having major concerns with transparency on their supply chain, allegations of child labor, insane work shifts, like 15 hours a day, 1 day off a month kind of stuff. It sounds like a lot of that is still sticking around. The company denies it in every way possible, but there's lots of firsthand reports coming from the ground in China of this happening. Nothing like a good dose of controversy going into an IPO, because it's exactly what you want, right? Are you guys how familiar are you with Shein? Pete, you got a trendy wife.
That's kind of like that's the only way I found out about it. Wasn't on my radar. Obviously, it's not in my closet, but something that's really taken off. And I think they were at pretty much like very much e-commerce first, understood that, and really entered what was kind of a dominated market already in fast fashion with like the H&Ms, and I think the Zara guy is one of the richest guys in the world now. Mm-hmm. So pretty interesting that they were able to come in here and kind of really make a name for themselves. It's just interesting, all the controversy you said. It's like, yeah, but everyone's pulling this from the same place, right? I know there's issues with their cotton sourcing and long work days in China. Like, these things have been blasted about several American brands since manufacturing really started taking place in Asia. So I think all those things might be true, but they're not necessarily the only ones guilty of it, right? And I think there's probably a lot of other reasons why. First of all, getting turned down by the New York exchanges, right? They tried to IPO there first. And I think it was one of the few items that both Republicans and Democrats agreed on, that they don't want that to happen. So I think that's really interesting. London taking that on, could that be a risk? Are they just in need of it? Obviously, I think the NASDAQ and the New York Stock Exchange are not hurting right now, both hitting all-time highs with companies literally worth more than London Stock Exchange. So I think that's pretty interesting too. Just, what's happened with the London Stock Exchange. I think I saw this would be the second biggest IPO of all time for them. So that's interesting. Yeah. So it's huge. So I think 66 billion is what they're looking for, 50 billion pounds.
Yeah.
That's so. Yeah, and them still being private, and I haven't seen a prospectus. Have you?
No, it's not there. I think the word on the street is that they're coming close. Somebody leaked the fact that it was going that direction, so we don't really have any, first-party information to work with. It's kind of like he said, she said. For example, one quote that I got was that their sales climbed from 10 billion in 2020 to 100 billion in 2022. Insane growth, but that's according to Bloomberg, so I'd say a reputable source, but I'm not really sure how that would work.
I'm looking at similar things. I couldn't track down an investor deck online. I looked through Crunchbase. I looked through some of the other ones. I could see some of the histories of who's behind some of their raises. You're seeing Sequoia Capital, China is in there. Their last raise was $2 billion. So, and the one before that was only about a year and a bit before, at 1.5 billion, and pretty tight cap table in a sense from what I'm seeing. It's been the same institutional funds re-upping. So they're seeing some things for sure, right? I saw about 23 billion in revenue and 800 million in net income. So not bad.
Nice.
Yeah. But did you guys ever watch the documentary, The China Hustle?
Oh, that's so familiar. Remind me.
Worth watching. It's actually wild. You guys need to watch it. Anyone listening, you should watch it. I think it's probably free on YouTube now, but it was kind of post '08 and just like, what do you invest in, right? And people were just seeing this growth of the Chinese GDP every quarter, boom, boom, boom. China is just booming, booming, booming. And a bunch of Chinese companies decide to list in the USA. The whole financial market's looking for anything to grasp a hope of, right? And I want to get the number right, but I think this doesn't sound too crazy that upwards of 300 Chinese companies got listed and just absolutely made up their numbers. Yeah. So it's worth watching, because the guy who did the documentary and some other finance people, I haven't watched it in a long time now, but went full investigative reporter on it and sent people to the factories because they were seeing their sales. And they're like, okay, if these are your sales, and let's say you're a manufacturing company, you would have trucks leaving nonstop. And they set up in like hotels, like across the street with cameras, that they're like, no one's working here, guys. Like, this company's a sham.
Oh my God.
Yeah.
Wow.
Yeah. So that was what I think this kind of went to the Senate, was like, hey, we've seen this before. Granted, some recent laws passed that I think give American more rights into like audits and things like that. But I also think right now there's quite this big, macro policy of friendshoring, where right now with China and BRICS, like, why does the United States want to help them out? How does that benefit, the U.S. economy by, funneling, let's say American dollars or American institutional funds or American retailers out of the country? I just don't think that's their prerogative. Yeah.
Yeah,
I'm sure Mr. Fundamentals has something to say about this. The valuation seems could possibly compelling.
Yeah. When it comes to Shein, I think it's a good business. They clearly have done a really good job breaking into the US market and North America, the West overall. Interesting fact is that they don't actually sell any products within China. They only do a lot of their manufacturing there. Sure. And so, but because of that, they still have very close ties to the country, and as well as have to working with the regulatory bodies there. And that's where a lot of the skepticism, I think, is being pointed towards. I was just reading from various different senators and U.S. representatives that are really questioning the validity and transparency of their prospectus, and then trying to make sense of all those allegations that you said before, Kev. There's a lot of question marks right now. And so is it a good business? Well, it certainly appears so. They've done a really good job, like I said, but it's just, you have a lot of murky gray water that you are trying to sort through in order to figure out, is this business telling the truth? Are they behaving in an ethical way? And are they doing things to fix and resolve some of those allegations that have been pointed towards them? And that was the thing, is they pointed right now, or Shein disclosed that as of right now, 1.7% of their cotton tested within the Xinjiang province in China. And that's where obviously these heavy allegations are coming from. So they're still, to some extent, they are operating within this region. And you just have to keep that in mind when you are going to look at a business like this. And that, for obvious reasons, is why the United States has been hesitant to allow them to IPO on their markets. Now, like Pete said, it doesn't excuse other businesses from doing it either. So I think this is just a general level of accountability. And that's what the great thing about capital markets is to some extent, you are going to get scrutinized as a business, and hopefully that helps improve your performance overall, your ethics overall, and just leads you to being a better business that, again, more positively affects us all rather than, trying to cut corners and the like. So that's kind of my thoughts on it.
That's got to be the most positive advertisement for listing on a stock exchange I've ever heard. For sending a clip to the NYSE.
Yeah.
But fair, all good points.
I do have a bit of a hot take on the business itself and why they made, because like really, like if they've had no problem raising money,
huge amounts of money,
and if they're making $1 billion a year as well, like why the rush to liquidity here? And I am curious, and like because this is okay, there's some advisors with some slippery mitts wanting to get out maybe, but you know what, we did the screen share last time. I'm going to do it here because again, this being such a big e-commerce company, we can actually see quite a bit of data on this. So I'm gonna do this again, guys, if you're okay with it.
Yeah,
because we have tools here at the agency to see what's going on. So pretty impressive. We can actually see all time. Can you guys see this okay?
Yeah.
Kind of when they launch and what their web traffic has been over time. And what I find interesting here actually is if we look at the last 2 years and then the last year, you're actually seeing a dip for the first time.
Oh, interesting.
So less people on the website usually means less people buying things. There's always usually a pretty strong correlation. It would be like less people going into any type of store. So they saw a bit of a dip, maybe with Google's recent updates for whatever reason. But what also is concerning to me is it looks like they're dropping their paid advertising dollars. And that is usually never a good sign of anyone we've worked with. When you kind of have a profitable model of getting customers online through paid acquisition, you keep it up. And you especially keep it up when it seems like you see a traffic and keyword drop, yet they've dropped their paid advertising budgets, looks like quite substantially over the last year. So that kind of just gets my spidey senses going. So I'm going to stop sharing my screen and let me know what you guys think about that.
Well, that's interesting because you'd kind of think like in periods of financial stress, like when rates are going up, food prices are going up, people want to stop spending. I mean, usually everybody needs clothes, right? People always spend on that, and it's the expensive clothes that go first. So you'd think something like Shein would thrive in an uncertain environment like this. Being not familiar with their clothes at all, maybe it's not like your everyday kind of clothes. Maybe it's something you get more for parties and stuff, and people are cutting back on that kind of thing. But I find it a little bit surprising to see them dipping. I would have thought something the opposite, basically.
And that was the story basically since inception. It really looked like everything was going better and better and better. Cutting ad spend, interesting. Like you're basically, if you're growing, you're always looking for new customers, and you've usually found a model of profitable like growth. Like you want to get as many customers as possible, and you spend, when companies that we work with are doing well, they keep spending more. When we hear budgets are getting cut back, it's like, well, okay, we're not doing as well. And, they kind of cut back on budgets, it looks like about a year ago. Again, everyone, disclaimer, it's third-party data, but it's the best thing we can get access to. And it's usually fairly indicative of what's going on. It's not like Shein gave me access to their analytics or sales dashboard, but it's something we quite rely on in our business. So would that make you rush to IPO before kind of any bad news has to be released?
Interesting.
Your first dip in sales.
Yeah. I'll add two thoughts that are kind of like separate. First is just, I'm curious from the side of like the ad spending, perhaps they've just found alternative channels that are more effective. I don't know, like you said, Pete, maybe with Google changing everything, there's opportunities. And this is certainly a company that's done well through other distribution methods like TikTok and has a strong following overall. Like, and to your point as well, Kev, in terms of the clothing and stuff, like they do sell overall like quality clothing. It's very, very cheap. It comes through quite quickly, all these different things. And so it's a good business from that standpoint. It's just that, again, now maybe why things are getting more constrained is due to the certain tensions between the US and China right now. And not China, but the US has certainly been quite aggressive in their tariffs and various methods to curb overall production from Chinese companies or manufacturers in China and the like, and just trade in general. So that certainly has to have some degree of an effect on the business overall. And then again, you just add in the additional allegations, and that may have even a greater effect on it. So I think those are just perhaps why. That's my rationale anyways for why things are dropping. I'm not saying that's why per se, but just my thoughts on the matter.
Yeah, I mean, I agree. And like I said, those allegations that the Democrats are talking about, whether it's their unethical working hours, sourcing, all these things, and then the Republicans saying, well, yeah, also we don't want to help this government out. They do X, Y, and Z. Why is the London Stock Exchange completely ignoring all of that?
Yeah.
Good question.
They need it, I guess.
They need it. Yeah. So
I can only guess after Brexit, it's probably been more challenging to court international companies, right? So maybe
I think that's really exactly it. Yeah.
Mm-hmm. Oh boy. Well, okay. Perfect transition. We're talking about the London Stock Exchange. Now we're going to talk about the Texas Stock Exchange. Honestly, brilliant. Like you look at the job growth, the population movement, Texas and Florida are winning in a big way right now, and for good reason. Government's super business friendly. It's kind of a bastion for those who maybe don't subscribe to woke ideologies. You want to go somewhere a little more gunslinger, guns and money. Texas and Florida welcome you with open arms, right?
They got it.
They got it.
Both things, guns and money.
I'm getting quotes that are not giving me a clear answer here, because multiple times I've read that Texas is home to more Fortune 500 companies than any other state. I've read that multiple times. Then I read one other saying second to California. So I don't really have the answer to that right now. I would have guessed California, actually, or New York State, but Texas, no surprise there. It's growing like crazy. Anyways, not much else to say. It's a private exchange. They've raised a ton of money. BlackRock and Citadel seem to be big supporters, kind of spearheading a lot of this. What do you guys think? Pete, does the world need an anti-woke exchange, or even just a new American exchange at all?
I think the U.S. could use a new exchange, right? Because you kind of have these two massive exchanges based in New York. Political ideologies aside, I think obviously if we are getting into that, there's certainly a bit of a libertarian skew towards Silicon Valley and everything that's really come out of there. They kind of tend to end up on the NASDAQ, which is just absolutely massive now. And then you have, the New York Stock Exchange, and they've gobbled up smaller exchanges over the years, and they are fairly expensive to list on. I think we've seen a lot of Canadians who have uplisted to the NASDAQ eventually not really anticipate just how much it costs to kind of be on there. And I had lunch with my corporate lawyer yesterday, who does a lot of M&A and activity, and we were talking about the Canadian junior markets and why, in essence, they are really a great thing because of the ease of access to public markets. Obviously, some people take advantage of that to the lower restrictions, but he's older than me and really talked about how Enron affected things and how, that made these markets a lot stricter, a lot, they'll scrutinize a lot more and have a lot more processes in place that ultimately the company itself has to pay for, right? You have to fund these things somehow. And those are, the expenses going on. I'm assuming with what's going on in Texas and their vision, it's going to be a little less restricted. Obviously, the SEC still has to kind of do their thing, but I like the idea of easier access to kind of public money. Do I love the BlackRock's behind it and Larry Fink? I don't know. Arguably, maybe the most powerful man in finance, potentially having more power, isn't something I necessarily love. Texas, though, awesome. I mean, you were talking about Canada's GDP. Texas's third quarter GDP, more than Canada basically as a whole, grew 7.7% over a year, 4.9%. Yeah. Unemployment is in a really healthy space. I mean, yeah, it's a great place. I think, I've pulled up some really interesting numbers. Yeah, their third quarter real GDP was 2.5 trillion. So, yeah.
So quite a bit.
Legit. Yeah, quite a bit. So,
economy.
Yeah. So if the, Toronto Stock Exchange is the top 10 exchange in the world, why can't Texas have something of the same? So I think it's very interesting. We'll see how it goes and if it gets across the finish line here. But something I'm really interested in. I'm assuming they would target energy quite a bit and oil and gas.
Yeah.
Just being
Declan,
there.
you live in the Texas of Canada. How does this conversation make you feel? What do you think?
Yeah, so I think I'll approach it from two angles. First, there has kind of been this trend over the years that the number of publicly traded companies has declined overall. So found a stat that in 1996, there was about 8,000 companies on US exchanges. And today there is only about 3,700. So a lot of the reasons listed or rationales as to why that happens is just the regulatory hurdles to actually get on some of these exchanges, as well as the general scrutiny by the market, being able, or more so the pressure that comes from quarterly reports and just the cost of maintaining that status. So on that side of things, it has deterred some businesses from going public. And if they don't require the capital, and say even management or the board of directors and whatever shareholders own the private business feel that there's no rush to liquidate their positions, then why not keep going private? Now, from that side of things, I think having an exchange in Texas and adding additional competition to the market is a fantastic thing. Maybe this will incentivize players to join who may have otherwise wanted to avoid it overall just because of the stringent requirements between the NASDAQ and the New York Stock Exchange. So that's a great thing. The other side of it is that right now there is 13 or roughly 13 stock exchanges in the US right now. There's one in Philadelphia. Wow. There's also one in Miami. And so this is nothing new. There are different exchanges throughout the country and throughout North America, all around the world. So do I think having more stock exchanges from that side of things is a good thing? I'm not really sure. Ultimately, I think when you go public, the goal would be that you're in a generally strong position as a business overall, and you deserve to kind of reach that next status or marker. And so if this does, I'm not saying it will, but if it does incentivize bad businesses to join, simply because it's more accessible, and now there's kind of this rat race between all these exchanges just to rake in as much money as possible, then if it brings on bad actors and bad players and people get hurt because of investments, then I'm not entirely sold. I just don't know yet. It's too early for me to tell, but that's kind of where I feel this is going anyways.
Well, you're not wrong. I mean, it's going to attract bad actors anytime there's less supervision, essentially. Like you look at some of the junior exchanges in Canada, it's the same thing. Easier it is to list a company means you're just going to get companies that are simply not as good. They wouldn't have met the threshold or the requirements of the more senior exchanges. I personally have been involved in, I forget the number now, it's like 28 or 29 initial public offerings or reverse takeovers. I won't get into the difference right now. And I've seen it all firsthand. One of those I did myself, A to Z, so I know every step of the way. And I can tell you it's not only a massive amount of time, effort, money. You need so many different people involved from, you need someone to do your books, like bookkeeping. Then you need the auditors to review that. You need to choose your exchange. There's paperwork for the exchange. You have to choose your investment bankers. I'm not even close to concluding what that list is. It's very long. Just the prospectus is an unbelievable amount of time and effort.
I was going to comment that though, Kev, like right when you were going there, sorry to cut you off, but how much easier would a prospectus be with AI right now? Because I know when we were working on those deals, like the prospectus is massive, but like, wow. Anyways, but continue.
That's actually a great point. I mean, you upload to like Google Gemini or something that has like a large context window, put a whole prospectus in. This is my closest competitor. I am not them. These are my stats.
This is how I write.
God, it would work too. I hate how well that would work because I know how much effort I put into writing those myself. But it's going to be okay. So fine, that will get easier, certainly. But it's like you get to a point where the whole point of going public is you want to, well, for one, be able to access growth capital. It's easier if you're public, simple. Two, it's a good thing being transparent, having your business on show for the world. Maybe it's not great for the business all the time. You don't want to show your competitors everything, but for the general investors and population, it is a good thing. And, 3, like it is kind of that what Mr. Fundamental said, being that next step of kind of notoriety. Fine, I agree with that, and I don't think you should just be rushing to the gates because it's easy. Usually people do that just because they want to cash out, right? That's the biggest reason companies will typically want an IPO. So there's going to be a combination of where, people are going to enjoy the lower burdens, the lower costs. That's a good thing for most people. But you're absolutely right. It's going to attract bad actors. Someone's going to get burned. That happens in junior exchanges all the time. It's just about being smart, watching podcasts like this, learn a thing or two, be able to protect yourself, because in all honesty, a small amount of cursory knowledge and you can avoid a lot of scams pretty easily. Just educate yourself. That's the best defense against anything negative like that.
Absolutely. Yeah. I would definitely agree with that.
Yeah, and well, I think so long. That's kind of like the catch-22 on this whole thing, or the double-edged sword, is that on one side, it's great that some of these exchanges do have such stringent requirements because it sets a precedent, and you're coming in and there's just a higher expectation that this business overall is in a good position. Now, as we all know, even companies listed on the New York Stock Exchange or NASDAQ are not always good businesses, but because they have to meet certain requirements, it at least kind of does some of the filtering in that way. And perhaps having Texas, if it does get to that size or brand that's equivalent to a NASDAQ or New York Stock Exchange, perhaps it has that same capacity. And maybe they, with this new approach, it's more modern, they find a way to listen and meet their customers, in this case the companies trying to list on their exchanges, demands, and find a way to kind of cater to some of those points that have prevented them in the past from going public, while also kind of maintaining that integrity overall. Because that's the thing is, again, I think to some extent that regulation is a good thing. And like you said, Kev, transparency, that's the best thing about public markets, is everyone can look, and you kind of have to make your own decision for yourself overall as to whether you make the investment or not. But I think it also does encourage or incentivize sometimes companies to come in and just think, hey, we're going to capitalize on this easy liquidity. Perhaps we'll target naive investors and be able to take advantage. And you just hope that doesn't happen, or at least that most people are savvy enough to recognize it.
But also the recruitment part, right? Being able to kind of print your own currency can incentivize you to get a lot of good people. So if you are giving out, healthy option agreements for great companies that are listed and people can go make money from the markets, not just their employer, you can get better people to work for you.
Big time, for sure.
Yeah.
And there's a big difference between an option package for a private and a public company. So many differences that, not to say with a private company it's worthless, it's definitely not, but it's like, unless your time horizon to stay with that company is generally 5, 6, 7, 8 plus years, you may not actually get the benefit of those options. And in some cases, you may actually be penalized in case you early exercise them. To avoid taxes, you can smoke yourself in a million different ways. So great point though, Pete. For an employer, that's a huge win to be able to have options for a publicly traded company.
There are some very rich Nvidia employees for sure right now.
Wasn't one of you making a joke about that? It's like they're having a tough time keeping people now because they're too rich or something like that.
No, I don't think so. I said, well, my university roommate at work started working there actually probably 6 or 7 years ago. He's a very humble guy, so he hasn't really let anything slip. He came back last month for a friend's wedding. But
you're like, so
what's going on? And I just asked him a few things, what it's like working there now and everything. And he's like, actually, it's not like the other kind of tech companies in Silicon Valley. He's like, they're pretty modest and frugal in a sense of what they do there, and their culture is more like, do good work and go home. We're not going to try to offer you 27 different types of bottled water to make you stay.
Oh man, that's wild. I don't know. I thought it was one of you guys that mentioned it, but it's like, apparently some employees' options packages have become worth so many millions that they're kind of like, why am I still here? Like, I'm worth $20 million. Like, I should just leave. And
easily. I think mid-level managers could be like that right now. If you think if they joined when it was 150 $200 billion company, which was great then. I don't think they could have ever imagined that. So you're getting whatever the stock price was then. I guess it's 1,300 now. So divide it by that, but let's call it a $50 option.
Wow.
And you have a lot of them. Not too hard to exercise that.
Yeah.
So that's that's a funny little soundbite. Let's see.
I just have one more comment kind of about, these are all the positives of publicly traded companies that we kind of mentioned, but when we get to that stage, the only thing I really don't love about us as a culture and valuation and how easy we sometimes flee companies is the idea that a company should grow every 90 days is so far-fetched often from reality that I think makes companies do shadier things than even they want to, because if anyone's run a business, growing it in 90 days is like this next to impossible feat. The only reason you kind of see consistent quarterly growth is likely the 10 years they put in prior, right? And it's all their systems like starting to fire, right? Like it's not just they didn't get better in that 90 days. It's all this groundwork they did to be a great company that then is starting to grow itself. Because like when they all of a sudden start seeing some things maybe slow down and stagnate, it's like, oh, well, now we have to fire 3,000 people. Otherwise, we're not going to show a profit. Otherwise, the market's not going to like us. Otherwise, all these other things that due to option agreements with executives, they're heavily inclined to do.
Well, you're right. I mean, the key, whether it makes companies make better or worse decisions, one thing that's for sure is it makes them make short-term decisions, right? Just like you said, hey, maybe Sheen is going to cut its ad spending just to boost profitability for an IPO and for the next quarter. Or you know what I mean? Like companies will make decisions like that, like layoffs and stuff that in the short term is going to make your balance sheet or your income statement look fantastic, even if it may be a net negative for the long term. But it always depends on the incentives. Like how is management incentivized? Is it purely stock price? Is it purely net profit? Is it other metrics related to growth? That's really, really important when you're evaluating where you think a stock's going to go in the long term.
Yeah, absolutely.
Yeah, totally.
Boys, I don't know. We're coming up on the hour there. I feel pretty good. Yeah. We covered a lot of diverse topics here. A lot of people commenting on the videos. I'll say we appreciate that probably a lot more than you know. It takes a lot of time, effort, money to put these together. So when you guys comment, ask questions, make comments, good or bad, like we love that. So more of that, and we thank you for it. We'll keep making another 1,000 episodes if you do. That's our deal. So, okay, from Small Cap Kev, Mr. Fundamentals, and Trend Tracker, this is episode 22